Państwa, którzy do nas dołączyli przez Zoom, można zadawać pytania poprzez ikonę Q&A. Tam mogą Państwo do nas pisać po prezentacji. Wszystkich Państwa witam, również tych, którzy oglądają nas za pośrednictwem social mediów dystrybuowanych przez portal Strefa Inwestorów. Tam również można zadawać pytania w każdy sposób, zarówno na portalu Strefa Inwestorów, jak i na YouTubie, na Twitterze czy na Facebooku. And a quick information for our English-speaking guests. If you join us by Zoom, you can use your interpretation channel, audio channel by clicking icon interpretation and set your audio to English, Polish, or off. You will get the original audio. So let me switch back to Polish right now. Zatem, proszę Państwa, zasady naszego spotkania są takie, widzę, że już do nas Państwo dołączają. Najpierw będziemy mieli krótką sesję pytań, przepraszam, najpierw będziemy mieć krótką prezentację, około 20-25 minut, może 30 minut, a następnie będzie możliwość zadawania pytań zarządowi. Na koniec oczywiście zarząd będzie na te pytania odpowiadał, pytania będę od Państwa otrzymywał na Q&A, będą one odczytywane. Następnie zarząd udzieli odpowiedzi i myślę, że około godziny 15:50 czasu warszawskiego będziemy kończyć nasze spotkanie. Będę Państwu sygnalizował, kiedy nasze spotkanie będzie się kończyć. Chciałem przywitać jeszcze gospodarzy naszego spotkania. To Andy Bond, CEO Grupy Pepco. Jest z nami również Nick Wharton, CFO Grupy Pepco. I jest również Matt Ankers, który odpowiada za strategię i relacje inwestorskie. Panowie, oddaję głos. The floor is yours.
Great. Thank you and welcome everyone to the first full year results presentation for the newly floated Pepco Group. And this is for the year ending the 30th of September 2021. The agenda, I will speak, giving you some highlights of our results, and then my colleague Nick will give you some more detailed financial assessment, and then back to me for a strategic and supply chain review, and finally myself and Nick will give some thoughts on the outlook for the group over the next 12 months, leaving us some time for Q&A at the end. So immediately on to the highlights of the group, and page 4 of the presentation. Look, whilst we're here to talk about this year's results, it's worthwhile reminding ourselves what our long-term ambition for the company is. We're here to build Europe's preeminent discount variety retailer. You know, this business and the value that we'll create is all about growth and about that aspiration to be Europe's preeminent discount variety retailer. So a few key headlines about the last 12 months. We delivered a strong financial performance despite the very volatile COVID-related trading conditions, and importantly, we delivered results in line with guidance and what we said at the IPO. Point 2, and perhaps most importantly, we're building a long-term platform for growth around some simple strategic pillars, which we'll explain in future slides. We are, as a consequence of the work we're doing and the market conditions, even more confident now than at the IPO and 12 months ago about our opportunity to grow long-term and deliver against the aspiration of being a business that has a profit stream of over €1 billion in 5 to 7 years. And finally, we feel we're managing the very significant headwinds, both operationally and financially. We're managing them well in very difficult circumstances, both around COVID and related inflationary effects in the supply chain. To the next slide, I won't say too much about the financial results. Nick will take over and give you the details, but the headlines would be: we delivered strong total sales and like-for-like sales growth. We delivered this through a very strong store opening program. You want to move the slide on, actually, please. Strongest ever store opening program, including Pepco's launch into 2 new Western European markets in the year, being Spain and Austria, having launched in Italy the year before, and also driving good same-store sales through improving the proposition we offer customers through our store renewal program, And then finally, we saw a rebound of gross margins to roughly pre-COVID levels through strong sourcing of goods and better markdown management. And finally, very tight management of our costs, which will be very important over the next 12 months to offset a lot of the inflationary headwinds. So that's the simple headlines. I'll now hand over to Nick, who'll go through a more detailed financial review.
Thank you, Andy, and good afternoon, everybody. As Andy has outlined, the past financial year has been a successful one, despite the challenges provided by the continuing impact of COVID on our business. Through ongoing restrictions on consumers, they reduced revenues and therefore in turn reduced the cost leverage that we have. And later in the year, we saw the introduction of cost inflation on our business, particularly of commodities and freight, which adversely impacted our cost base. So just looking at this headline slide, which is slide 8 in front of you, and we'll cover off this before moving on to the detailed financials. And what you can see here is the year included a number of important milestones that in turn helped to drive our financials. So firstly, in terms of new stores, this year saw a record 483 stores opened across the group, including 59 acquired through Poundland's acquisition of Fulton's Frozen Foods. And significantly, we opened stores in all of our operating territories. As Andy has said, we successfully entered in the Pepco brand 3 new territories. Of particular note, 2 of those were continued expansion into Western Europe, where we opened stores in Spain and Austria following the entry to Italy in the previous year. And just for completeness, the 3rd market that Pepco entered was Serbia, which we opened in that year. In terms of store refits, we have now well-planned and established ongoing programs in both Pepco and Poundland to introduce new categories that our researchers confirmed that our customers wish to buy for us. And the biggest example of that is the introduction of chilled and frozen products into Poundland. And this store relay program also optimizes space allocation across stores in order to both allow for these new categories, but also to enhance our overall store environment. In the year, we completed around 1,000 of these store refits, with 827 delivered in Pepco and 127 in Poundland. And we've got significant capacity for further refits in the future, which will contribute to our future like-for-like performance. We also continued to invest in our infrastructure. We commenced the 3-year implementation program for Oracle as our new Tier 1 ERP, and also continued to optimize our DC infrastructure. That saw us ramp up the latest DC that we opened for Pepco, which is located in Hungary, in order to better match and serve our Central European estate. While in Poundland, we delivered greater distribution efficiency by closing one of the 4 UK DCs that we previously had, consolidating the volume in the remaining 3. So turning now to the next slide, into our detailed financials. Sorry, next slide, please. Thank you. And this slide covers group level performance. And as you can see from the top, revenue grew year on year by 17.2% in the year. This was driven by group level like-for-like of 6.5% and the opening of those 483 new stores, which in store portfolio terms represents an increase of 16% over the previous year. Looking through the P&L, underlying EBITDA, which reported here on a post-IFRS 16 basis, increased by just over 200 million euros year on year, or 46% on a COVID-impacted FY20. Similarly, the EBITDA margin benefited from this performance and gross margin expansion in particular, and grew in total by 310 basis points to 15.7%. In terms of depreciation, our depreciation charge grew by 12% year on year, and this is a positive for us as it primarily reflects the expansion in store numbers that we've talked about previously. The interest cost that you can see on this slide reduced by 25% versus the previous year. And this reflects improvements in two regards. Firstly, we refinanced our debt before the IPO was completed, and that reduced the interest coupon that we pay on our debt. And secondly, we reduced our net debt from working capital interventions made in response to COVID pandemic. So as a function of all of these, our underlying PBT has increased fourfold year on year to 244 million euros. We are reporting some non-underlying costs, which total 48 million euros in the year, with over 60% of those costs associated with the IPO. So specifically, the transaction and advisory costs associated with the IPO totaled 21 million euros. The refinance that we completed at the time of the IPO, which was forced by the change of control, which happens at that time, totaled 9.1 million euros, of which the substantial majority were early repayment fees. And finally, the accounting cost of management's VCP, which was detailed in the IPO material, was 15 million euros. And just for completeness in terms of the cost of the IPO, we also incurred 12 million euros of IPO cost in the previous financial year. So the total cost of the IPO was 33 million euros. Next slide, please. Thank you. So focusing now on costs, as you can see from the top slide, gross margin increased year on year by 220 basis points, reflecting both the ongoing scale-led benefit that we see from our direct sourcing operation, and secondly, levels of markdown also reduced materially year on year. This reflects two factors. Firstly, from a COVID perspective, in FY21, in contrast to FY20, we were more able to reduce the level of our buy in line with anticipated lower volumes. Naturally, in FY20, the impact of COVID occurred after our buy had been confirmed. And secondly, and very significantly for our future benefit, markdown levels have benefited from systems development, which allows more specific markdown levels by store rather than historically being implemented by country. Excuse me. The gross margin increase was further augmented by operating cost efficiencies. And in total, these represented about 1% of sales. And to be clear, these benefits included the benefit of furlough and business tax and business rate support received in many of our jurisdictions. But in total, these margin and cost improvements led to a year-on-year EBITDA increase of 46%. Next slide, please. So firstly, drilling into our segments and firstly focusing on Pepco. And is important context reflecting the strength of Pepco's market position. The Pepco segment represents about 70% of the group's EBITDA, generated from just over half of its turnover. Pepco remains the core growth engine of the group, and it delivered 25% increase in its revenue over the year and achieved this from 364 new stores, or about 17% portfolio growth year on year, plus a like-for-like performance at 10% as the business rebounded from the COVID impact in the previous year. As you can see from the middle block of this data, which details our like-for-like performance by by quarter. Like-for-likes improved through the year with a particularly strong performance in the third quarter, and our third quarter runs from April to June. And this occurred as the business rebounded from significant government restrictions and customer reticence to shop in high street locations in the initial period of COVID, which corresponds to this period in Q3 in this year. As an indication of that, in quarter three in FY20, almost 20% of trading weeks were lost to store closures, compared with only 7% in that quarter in FY21. And with operating costs managed very closely, growing only at 19% compared to that 25% growth in revenue, our underlying EBITDA in the Pepco segment grew by 53%, with operating margins returning to above 20%. Turning to the next page, which covers the same details for our Poundland segment, which, as you know, includes deals. Benefiting from a strong like-for-like performance of 3.1% and continued store expansion in deals, our overall revenues expanded by almost 10%. And as you can see from the middle block of data, followed a similar calendar profile to that seen in Pepco. In the Poundland Group, our EBITDA expanded by 39%, benefiting from a 1.2% increase in gross margin, and operating cost leverage driven by our continued focus on rent renegotiation, and also business rates and furlough support from the government in that business. So reflecting the above, operating margin expanded year on year by about 1/4 to 10% in that business. Next slide, please, which covers cash flow. Cash flow generation remains an extremely important part of our overall business model and was strong throughout the group in FY21 based on the proactive action that we took as a management team post-COVID, significantly improving the group's working capital position. As an example, we renegotiated our creditor position with our most important suppliers, and this, after successful renegotiation, extended our average credit terms by 12% year on year. As a further signal of our balance sheet strength, during the year we used 130 million euros of cash sitting on our balance sheet to repay external debt as part of the refinance successfully completed as part of the IPO. But despite this cash utilisation, we closed the year with over €500 million of net cash and net debt on a pre-IFRS 16 basis of just over 100 million euros, which represents about 1/4 of the equivalent EBITDA. So moving to the next slide and finally to summarise. So to summarise, the year has seen strong progress on all fronts. Our prime value creation lever is store openings, and those increased materially year on year to 483 stores, including our initial stores in Austria, which are acquired from a parcel of 24 stores that we bought from CCC. And therefore that presence at an instant 24 stores will give us a good scale and presence in Austria. And naturally that expansion is part of the wider intention to make Pepco a pan-European brand. Our profitability has recovered well in the year, benefiting from 6% like-for-like at the group level, enhanced margins and operating cost efficiencies. And this increase in earnings, together with enhanced working capital from those management interventions to reduce stock holding, has led to a significantly strengthened financial position. We continue to invest in quality infrastructure. We opened an additional distribution centre to enable Pepco's further expansion, and we commenced the replacement of the group's core enterprise systems with the Tier 1 application, Oracle. So I'll now pass back to Andy, who will cover our strategic development in the year.
Great, thank you, Nick. If we could move on one more slide, please. So in terms of our longer term progress, we see our business developing along 4 main themes to create value for shareholders. Firstly, to accelerate our rate of new store openings. 2, to drive consistent high levels of like-for-like growth. 3, to reduce our costs of operations. And finally, to deliver all that through enabling growth with investment in infrastructure and fantastic colleagues. And I'll address each of those in our progress in turn. So moving to the next slide, I talk here about our store opening program. You can see the map gives the number of stores that we opened in the financial year 21 in each territory. And I make the following simple points. Firstly, the majority of our store openings remain in our core Central and Eastern Europe territories. Point 2, we highlight the progress we're making with Pepco entering Western Europe. And finally, you can see the good progress we're making with the deals part of the Poundland Deals business as a long-term new growth vehicle. And then to the bullet points on the right of this slide to highlight that the key features of our growth program. Pepco entered 3 new territories, and I'll talk about Western Europe in the next slide. Our largest ever Pepco store opening program at 364 stores. We've talked a little bit about Western Europe. Again, to reiterate, 65 deals openings, which is a fantastic rate of progress. And all of this achieved without diluting our financial returns. So a very strong program of growth, which we will continue into this year. So moving to the next slide, we've said on a few occasions that we feel increasingly confident about Pepco in Western Europe. And this slide tries to explain, using the example of Italy, but this could also be Spain, why we feel confident in our growth. And to the bullet points at the top right, the key features of our business are that our stores tend to have roughly the same number of shoppers as our core business in Eastern Europe. And yet those shoppers spend significantly more each time they visit, delivering roughly twice the sales per store as our core markets. Those extra sales allow us to offset the incremental costs that you experience in higher cost environments such as Italy and Spain. So to the bottom right of this slide, our business delivers a stronger cash profit. We were improving our working capital and CapEx model, and hence we deliver still extremely strong returns, well above a 35% internal rate of return. On the bottom left, this chart tracks the average basket size with the average income per head of each of our major markets. And you can see the very strong correlation between, as wealth increases by market, people spend more with us. This is so important to identify our confidence that our sales will grow in markets where people are more affluent, because we're starting to experience that for reality. So we're now very, very confident to start accelerating our rate of store openings in Spain and in Italy, as well as announcing that we will enter the German market. To the next slide, our same store sales, what we call like-for-like growth, is embedded in the fact that we're improving the offer for our customers. In Pepco, that is about improving all of our products, but particularly our better and best products. Simple example being our Peter Cook cookware range, which is trading extremely well, expanding into different new categories, such as a fantastic candle range. And all of this is being implemented in stores across the network, but particularly in stores where we're renewing the store, where we're investing to improve the experience for customers. And that investment is delivering an 8-month payback. On the Poundland Deal side of the business, we're improving again the offer for customers We're increasing the range of price points we sell. We're increasing the category breadth as well as depth. And all of this, again, is enabled by a store renewal program with a very strong return on invested capital as well. The next slide, reducing our cost of business, very important at any time, but particularly at the moment as we're experiencing significant cost pressures elsewhere in our P&L, as we've said. And I highlight in this slide some of the key deliverables. In Poundland, our rent program continues to deliver very significant savings, 37% average saving at lease renewal, with over 200 leases renegotiated and with over 200 leases to be negotiated in the next 2 years. Pepco is undertaking a transformational review of its whole supply chain from source to customer, with some remarkable results already. 70 million euros saved in markdown in FY21, and that it will be replicated into this year, and significant distribution savings by reducing mileage travelled. And then finally, in labour, savings across the group, but most notably in Pepco, where our reduced inventory holdings in stores has allowed us to reduce the labour complement because there's less double handling of inventory. Next slide gives a bit more of a deep dive into our flow of goods in Pepco. Our end-to-end supply chain management is fundamentally about reducing the level of inventory we have in our supply chain pipeline, with very significant benefits. So moving from left to right, the reduced inventory levels mean we have less stock at the end of season to mark down. It means that we have less of a need to manage more stock in stores, and therefore can reduce the labour. And it also means that we're saving cash because we have 3 weeks less inventory in stores. So less markdown, less labour, less distribution costs, and saving cash in terms of our inventory commitment. So a very strong programme which will underpin our results into the future. To the next slide, our infrastructure programme is on 3 basic building blocks: new systems, better physical infrastructure, and investing in promoting our colleagues. So in terms of systems infrastructure, as Nick has said, a lot of work in our ERP system, but also in warehouse management and HR and EPOS systems. Physical infrastructure has been built around a new DC for Pepco, less DCs for mainland UK, and a new DC for Deals in Ireland. And then from a colleague point of view, we see ourselves providing fantastic careers for colleagues. We've promoted over 2,000 people in the last year. Nearly 90% of our store manager promotions have been from within, and we have a very successful apprentice programme. All of this giving us confidence we have highly motivated colleagues. And moving on 2 slides, then, clearly supply chain management is a very big problem for all retailers at the moment, and we are no different to anyone else. Starting on the left of this slide, we see inflation really in 2 different ways. Container freight and commodities the construct of our products, we see has been cyclical, and by early calendar year 2023, we think these will abate, whereas we think labour costs will be a structural long-term issue for us to manage. And that is the nature in which we're planning the way we handle inflation. To the middle box, we've made a very clear commitment to keep our prices down and not pass on the significant element of that inflation to our customers. We think that's the right thing to do for customers and hence our business. But we'll leverage as much as we can in terms of lowering our cost of goods from suppliers, and as I've already described, keeping our cost doing business low. And to the right of those buckets of presentation, we also clearly see these headwinds, not just in cost, but in disruption to availability. And we've done some pretty innovative things to try and get inventory on our shelves. And then finally on this slide, if you look at the bottom of the page, what should give you confidence that we have a plan to offset these cost financial 22 is many of them were already apparent in our business in Q4 of the financial year we're reviewing. And we offset around 25 million of headwinds through the initiatives already described, and that will annualize into this year. So we already have the vast majority of those headwinds covered by actions we've already described. With that, I'll hand back to Nick, who'll talk about the outlook and current trading of the business, and then I'll make some final remarks.
Thanks, Andy. Next slide, if you could, please. Thank you very much. I think the most significant point to make in terms of outlook is that our confidence in the long-term growth opportunity that's available to us across the business remains intact, and nothing that we have seen during FY21 diminishes that in any way. We are still very confident about the scale of the long-term opportunity. Starting with the current view in terms of the current quarter, we're pleased that our strong strategic progress we saw in FY21 has very much continued at the start of the current financial year. I guess the examples of this, in the first 2 months, October and November, we opened over 80 stores, so very much maintaining the accelerated opening rate that we saw in FY21. And with 2 months gone of our largest revenue quarter, our trading performance is very much in line with our internal expectations. So a very positive and important start to the year. However, the future impact of COVID remains uncertain on our business. Until recently, we had one territory, Austria, that was fully closed, with many others experiencing consumer restrictions of various types. That includes restrictions on the range of products we are allowed to sell, or stores, for instance, in Romania, only allowing entry to fully vaccinated customers, which obviously impacted the footfall that we had to those stores. Consequently, at this point in the year, with our current knowledge of COVID impacts on the business from a revenue perspective, but also from a cost perspective, but balanced by our capability that we proved in the last financial year to very flexibly balance volume, margin and operating costs, we continue to anticipate delivering full year profit growth in line with historic growth levels of around 20%. So on that basis, I'll pass back to Andy for his closing summary.
Look, just a few summary remarks, and these are exactly as we started. I think FY21 was a very strong financial performance despite the COVID headwinds we've described, which do unfortunately carry on into this year somewhat unexpectedly. We feel we have all the right building blocks to deliver long-term sustainable growth through the pillars I've described of new store openings, strong like-for-likes, leveraging up our growth into lower operating costs and supporting all this with strong infrastructure and fantastic colleagues. That gives us even more confidence about long-term opportunities. As financial pressures hit our customers, even more people will seek the value we offer. So we're even more confident about our future. And we're equally confident that whilst no business is immune to needing to manage the headwinds of inflation and supply chain disruption, we seem to be managing these well through good operational agility and strong management experience. So in all, a good set of results, and we're very optimistic about our long-term prospects. With that, we'll hand back to our moderator for questions.
Bardzo dziękuję zespołowi zarządzającemu za prezentację. Teraz zachęcam do zadawania pytań. Przypominam, że pytania zadajemy wyłącznie w formie pisemnej. Nawet ci z Państwa, którzy są na Zoom, dzisiaj nie będziemy włączać mikrofonów. Prosimy o zadawanie pytań w pliku pod ikoną Q&A. Prosimy również zadawać te pytania w social mediach, wszędzie tam, gdzie Strefa Inwestorów udostępnia Państwu sygnał do oglądania, czy na YouTubie, czy na Twitterze, czy na portalu. Czytamy te pytania, widzimy je. Mamy już pierwsze pytania, więc może ja je będę zadawał. Inwestor indywidualny, który nas ogląda na strefie inwestorów, pyta, czy w związku ze wzrostem inflacji zamierzacie w przyszłym roku podnosić ceny w swoich sklepach?
Yeah, it's a good question, and clearly, it is an important question for us. To be clear, right now, our intention is to keep the vast majority of our products the same price as they were a year ago. So we are not intending to pass on the vast majority of the cost pressures that we experience. We're not going to pass those on to customers. What we prefer to do is try and manage those costs ourselves through better operating efficiencies and theoretically higher sales. We also think it's important to keep prices down very simply because our core customer is a mum on a very tight budget who will have many other pressures on her household expenditure. And as a consequence, frankly, if we put our prices up, she would just be able to spend less with us. So there's a real logic to keeping our prices low, and we are very confident, gain market share by doing this.
Dziękuję bardzo. Kolejne pytanie inwestora indywidualnego. Jak przebiega rozwój sieci Deals i odbiór jej przez klientów w Polsce?
Yeah, good question. We have 3 markets where we trade as Deals, and Deals is in effect very similar to the Poundland business in the UK, which itself is a large replica of the US dollar stores. The 3 markets being Ireland, Republic of Ireland, that is, Spain and Poland. All 3 of those markets are trading well, and we will continue to grow in all 3 markets, but we see the biggest white space and opportunity for us in Poland. We, in July, I think it was, celebrated 100th store in Poland, and we intend to start, as we demonstrated earlier, hopefully, we intend to accelerate our rate of growth of Deals in Poland. It's too early to say what the market opportunity is, but we see the opportunity for many hundreds of stores in Poland over time, and we will start to accelerate our growth in Poland to meet that opportunity.
Just to build on that, as Andy says, our confidence in the Deals proposition is now proven, and we are accelerating the rollout of that fascia. So last financial year, we opened around 60 Deals stores, the previous year around 30, and in the current year, we are anticipating doing in excess of 100 new Deals stores. So it really is a second significant leg of growth for the business as well as Pepco.
Dziękuję bardzo. Mamy pytania o e-commerce, zarówno od inwestorów indywidualnych, ale jest też pytanie pani Magdaleny Głowackiej, dziennikarki portalu Wiadomości Handlowe, więc ja to pytanie może zbiorę w całość. Jak oceniają Państwo pierwsze tygodnie sprzedaży produktów Pepco na platformach Marketplace? W jakim kierunku będzie zmierzać strategia Pepco wobec platform Marketplace? I czy to będą wszystkie produkty dostępne? Czy też marka będzie traktowała ten kanał jako kanał do wyprzedaży?
Yeah, I mean, it's too early to judge how the trial has gone. I'll take this opportunity to remind people of our thoughts online. I mean, any good business strategy must meet 2 equally important needs. 1, what do our customers want from us? And 2, can we make money from that strategy? In general, it's our strong view that our customers like shopping in shops, they like our low prices, and most importantly, they cannot afford to pay roughly €3 to have something delivered to home when they're only spending roughly €8 in our shop. On that basic premise, whilst we are trialing our proposition online, the economics of our business make online relatively unappealing to either us or our customers, but we are trying it. As I say, it's way too early to make judgments, but The bottom line for me on this is that by far our biggest value driver in the next 5 years will remain the levers that we've described: opening as many shops as we can, driving like for like in our stores, and leveraging our growth into lower operating costs. Those things will deliver significantly more shareholder value than online, but we are trying it, and it's way too early to make judgments as to what that trial is telling us.
Dziękuję bardzo. Kolejne pytanie inwestora indywidualnego. Czy bierzecie pod uwagę wprowadzenie oferty premium do swoich sklepów, żeby podnieść marżę? Wprowadzenie nowych produktów, na przykład produktów wyższej jakości?
Yes, although I certainly we are in both our core businesses, Poundland Deals and Pepco, introducing higher price point products. They are appealing to our customers. I gave the simple example of our cookware range, Peter Cook, in Pepco, which is a higher price point product, and that is selling very well. I'm not sure that I agree that it is inevitable that those higher price point products will lead to higher gross margins, because whatever we sell must be great value. And certainly even higher price point items, we will not start intentionally raising percentage margins. Theoretically, the cash margin will be high, but at a percentage level, we will not be trying to increase margins that way.
Dziękuję. Kolejne pytanie inwestora indywidualnego. Jaki wpływ na przyszłoroczne wyniki może mieć wzrost stóp procentowych w Polsce, ale generalnie chyba środowisko stóp procentowych się zmienia w Europie, więc może tutaj jakiś komentarz.
Well, look, I'm not an interest rate forecaster or a financial forecaster, but look, I mean, the answers would be this, and it reinforces our strategy of keeping price low. Anything that creates incremental costs onto our core customers' household income will leave that person with less money to spend in our shops. Therefore, the best thing that we can do that's within our control is keep our prices as low as we can, because more and more customers will be attracted to low-priced retailing at a time when their household incomes are under pressure. That's the critical part of that story. The other thing I'd say is, just as a reminder, whilst our home market and our heart is in Poland, let's be clear, it is not the majority of our business. The majority of our business comes from outside Poland, whether it be the rest of the Pepco business or the Poundland business. So we are now a much broader European business, so we shouldn't see our business as purely being impacted by Polish government policy.
Dziękuję bardzo. Mamy jeszcze jedno pytanie. Ja przypominam, że pytania można zadawać zarówno dla tych uczestników, którzy są zalogowani na Zoom poprzez Q&A, albo wszędzie tam, gdzie Państwo nas oglądają, czy na YouTubie, na Twitterze, czy na platformie, na portalu Strefa Inwestorów. Zachęcamy do zadawania tych pytań. Informuję również, że prezentacja, którą Państwo widzieli, będzie dostępna na stronie Grupy Pepco. Także proszę wbić Pepco Group, nie Pepco, tylko Pepco Group, i tam ta prezentacja będzie dla Państwa dostępna. Natomiast pytanie inwestora indywidualnego jest następujące. Czy otwieranie nowych sklepów w 2022 roku będzie się wiązać z większymi kosztami, na przykład poprzez wzrost kosztów materiałów budowlanych? Czy otwieranie nowych sklepów odbywa się w lepszych warunkach, jeśli chodzi o koszty najmu? Czy te koszty są niższe niż dotychczas?
Yeah, it's a good question. First of all, in general terms, our capex per store in the existing markets we have is reducing, because we're being very efficient at renegotiating our contracts with shop fitters, with fixturing suppliers, etc. So whether it be Poland, Romania, etc. In each market, our capex is going down. However, as we open more shops in Western Europe, the mix will mean that our costs will go up, because those markets are innately more expensive. to employ shop fitting companies, etc., as well as our leases. So in general terms, in each market, we're not seeing that effect of inflation. Quite the opposite, we're seeing some deflation based on good negotiating. But the mix effects of opening more stores in high-cost countries means overall the per store costs will go up.
Dziękuję. Jeszcze pytanie o inflację, to w takim razie czy ceny w sklepach będą wyższe?
No, to be clear, in all the markets we trade in, we keep our prices the same. So a store in Italy, a store in Spain sells the merchandise exactly the same prices in Eastern Europe. And we will not be raising prices because of higher costs. As I hoped I explained with the example of the Italian stores, our extra sales that we're getting by keeping our prices low is driving a very successful business model. We're delivering very good sales, which are offsetting the extra costs, and hence we're still delivering very good profits and return on invested capital.
Dziękuję bardzo. Na razie nie widzę więcej pytań, więc informuję, że to jest ostatnia szansa na zadawanie pytań, bo mamy jeszcze 2 minuty tak naprawdę, żeby zakończyć nasze spotkanie. Więc pytanie po raz pierwszy, po raz drugi, po raz trzeci. Pytań nie widzę. Andy, oddaję głos, jeśli możesz podsumować nasze dzisiejsze spotkanie.
Well, look, I just say thank you to everyone for your time, and also thank you for investing in our business. And the slide there reinforces the key points. We feel very good about the results we delivered. We feel good about this year, but most importantly, we feel very good about the long-term prospects for the company. And with that, I'll say thank you, and those of you who celebrate, happy Christmas.
Thank you.
Dziękujemy bardzo zespołowi zarządzającemu. Zapraszam Państwa na stronę Pepco Group, tam są wszystkie informacje o spółce. Dzisiejsze informacje również są dostępne na stronie. Prezentacja wkrótce będzie dostępna na stronie. Dziękuję bardzo zarządowi za czas poświęcony i uwagę dla inwestorów indywidualnych. Widzimy się już wkrótce. Dziękuję bardzo, do zobaczenia.